I need to warn you about something that's going to catch almost everyone by surprise. Something that could freeze credit markets, crash asset prices, and trigger the most severe financial crisis since 2008. I'm talking about a liquidity crisis, not a slow burn, not a gradual tightening, but a sudden violent seizure where the financial system runs out of cash and nobody can get funding. And based on everything I'm seeing right now, it's going to hit in 2026, maybe earlier. Let me be clear about who I am and why you should listen. I'm Michael Burry. I predicted the 2008 financial crisis when everyone else said the housing market was fine. I shorted subprime mortgages when the entire financial establishment told me I was wrong. I paid premiums on credit default swaps for months, while my investors questioned my sanity and major banks sent people to my office to explain why I didn't understand risk management. And then I was proven right. The housing market collapsed. The mortgages defaulted. Bear Stearns failed. Lehman Brothers failed. The entire global financial system nearly went down. And I made over 700% returns from my fund, while everyone else lost everything. I was right because I did the work. I read thousands of mortgage documents. I analyzed the data that everyone else ignored. I understood the mechanics of how the system would break. And right now, I'm seeing the same kind of systemic fragility building. Except this time, it's not about housing. It's about liquidity. The financial system is running on borrowed time and borrowed money. And when the liquidity dries up, everything breaks. Let me start by explaining what liquidity actually means, because most people use the word without really understanding it. And if you don't understand what liquidity is, you can't see where it's going to break. Liquidity is the ability to convert assets into cash quickly without significant loss of value. It's the oil that keeps the financial system running smoothly. When there's plenty of liquidity, markets work efficiently. You can sell a stock or a bond or a piece of real estate and get cash almost immediately at a fair price. Buyers are readily available. Transactions happen smoothly. But when liquidity dries up, when there aren't enough buyers, when everyone wants to sell at the same time and nobody wants to buy, that's when you get a liquidity crisis. Prices collapse. Markets freeze. Companies that were fine yesterday suddenly can't get funding and fail. There are different types of liquidity, and they all matter. Market liquidity is the ability to buy and sell assets in markets. Funding liquidity is the ability of financial institutions to meet their obligations and access cash. Asset liquidity is how easily specific assets can be converted to cash. In a healthy financial system, all three types of liquidity are abundant. Banks can fund themselves easily. Markets have deep pools of buyers and sellers. Assets can be sold at fair prices. But these different types of liquidity are interconnected. When one dries up, it often causes the others to dry up too. This creates cascading failures. Let me give you an example from 2008. Lehman Brothers had plenty of assets. They owned real estate, they owned mortgage-backed securities, they had loans on their books. On paper, their assets were worth more than their liabilities. But when funding liquidity dried up, when other banks refused to lend to them overnight, when the commercial paper market froze, Lehman couldn't fund their daily operations. They had assets but no cash. They were forced to sell assets to raise cash. But market liquidity had also dried up. Nobody wanted to buy mortgage-backed securities. The buyers had disappeared, so Lehman had to sell at fire sale prices. This created losses. The losses scared other lenders even more. They pulled back further, and Lehman spiraled into bankruptcy. That's a liquidity crisis. You can be solvent on paper, but insolvent in practice because you can't access cash. And once it starts, it feeds on itself. Now let me tell you what's different about the current situation and why the next liquidity crisis could be even worse than 2008. The Federal Reserve has spent the past 15 years flooding the system with liquidity. After the 2008 crisis, they cut rates to zero. They kept them there for 7 years. They did 3 rounds of quantitative easing, buying trillions of dollars of treasury bonds and mortgage-backed securities. They printed money and injected it into the financial system. This created enormous amounts of liquidity. Money was essentially free. Banks could borrow at 0%. Companies could issue debt at record low rates. Asset prices inflated across the board because there was so much money chasing investments. When COVID hit in 2020, the Fed went even further. They cut rates back to zero within weeks. They started buying bonds again at an unprecedented pace. They bought over $4 trillion in bonds in less than 2 years. They expanded their balance sheet to nearly $9 trillion. They created more liquidity in 2 years than they had in the previous century. All of that liquidity had to go somewhere. It inflated everything. Stock prices, bond prices, real estate, private equity valuations, cryptocurrency, art, collectibles. Everything went up because there was too much money chasing too few assets. But now the Fed is doing the opposite. They're removing liquidity from the system. They started raising interest rates in 2022, from 0 to over 5% in less than 2 years. That's one of the fastest tightening cycles ever. But more importantly, they're doing quantitative tightening. They're letting bonds roll off their balance sheet without replacing them. They're shrinking the money supply. Every month, billions of dollars in bonds mature and the Fed doesn't reinvest the proceeds. That money disappears from the system. The Fed's balance sheet has shrunk from $9 trillion to around $7 trillion. And they're continuing. This is withdrawing liquidity from the financial system at a massive scale. And here's what most people don't understand. The withdrawal of liquidity doesn't affect the economy immediately. There's a lag. Just like with interest rate hikes, it takes time for the impact to be felt. The financial system is like a bathtub. The Fed spent 15 years pouring water in. The tub was overflowing. Now they've turned off the tap and opened the drain. But the tub is still pretty full. It takes time for the water level to drop. We're in that period right now. There's still liquidity in the system. Markets are still functioning. Companies can still access funding. But the water level is dropping, and at some point, it's going to get critically low. That's when things break. I think that point comes in 2026. Let me explain why. First, look at what's happening in the Treasury market. The Treasury market is the foundation of global finance. It's the largest and most liquid bond market in the world. Over $26 trillion in Treasury securities outstanding. Everybody uses Treasuries. Banks use them as collateral. Money market funds hold them. Foreign governments hold them. Pension funds hold them. They're considered the safest asset in the world. But the Treasury market is showing signs of stress. Liquidity in the Treasury market has deteriorated significantly over the past few years. Bid-ask spreads have widened. That means the difference between what buyers are willing to pay and sellers are asking has increased. That's a sign of reduced liquidity. Market depth has declined. That means there are fewer buyers and sellers at each price level. If you want to sell a large amount of treasuries, you have to move the price more than you used to. Trading volumes are more volatile. Some days there's plenty of activity. Other days the market is thin. This is dangerous because the Treasury market is supposed to be the most liquid market in the world. If liquidity is declining there, it's a warning sign that systemic liquidity is under stress. Why is this happening? Several reasons. First, banks are holding fewer treasuries than they used to. After 2008, regulations required banks to hold more capital and more liquid assets. Banks loaded up on treasuries. They became the biggest market makers in the treasury market. But now, with interest rates higher, banks have taken massive losses on their treasury holdings. When rates go from 0 to 5%, the value of existing bonds falls dramatically. Banks have over $500 billion in unrealized losses on their bond portfolios. They're sitting on these losses, not selling, hoping rates come down and the bonds recover value. But this means they're not actively trading. They're not providing liquidity to the market like they used to. Second, foreign buyers are pulling back. For decades, foreign governments, especially China and Japan, were huge buyers of U.S. treasuries. They recycled their trade surpluses into treasuries. China alone held over $1 trillion. But that's changed. China has been selling treasuries for years. They're down to around $800 billion. Japan has been selling too. They need the money domestically as their population ages and their economy struggles. These foreign buyers provided stable demand. They absorbed supply. Now that demand is shrinking. Third, the U.S. government is issuing more treasuries than ever. The federal deficit is over $1.7 trillion per year. That means the Treasury Department has to issue $1.7 trillion in new bonds every year just to fund the deficit. Plus, they have to refinance maturing debt. The total issuance is over $7 trillion per year. That's an enormous amount of supply hitting the market. So you have reduced demand from banks and foreign buyers. You have increased supply from the government. Basic economics says when supply goes up and demand goes down, something has to give. Either prices have to fall, which means yields have to rise, or buyers have to be found elsewhere. The Fed was the buyer of last resort. During quantitative easing, the Fed bought massive amounts of treasuries. They absorbed supply that private markets couldn't. But now the Fed is doing the opposite. They're selling, or at least not buying. So who's going to buy all these treasuries? This is the liquidity problem. If the market can't absorb the supply, if buyers don't show up, treasury yields are going to spike. And when treasury yields spike, everything breaks. Because treasuries are the risk-free rate that everything else is priced off of. If treasuries are yielding 7 or 8%, what do corporate bonds have to yield? What do mortgages have to yield? What do stocks have to yield to compete? Asset prices across the board would collapse. Second, look at what's happening in the repo market. The repo market is the plumbing of the financial system. Most people have never heard of it, but it's critical. Repo stands for repurchase agreement. It's a short-term loan, usually overnight, where one party sells securities to another with an agreement to buy them back the next day at a slightly higher price. The difference is the interest rate. Banks and financial institutions use the repo market to manage their short-term funding needs. If a bank needs cash for a day, they repo out some treasuries. If they have excess cash, they lend it in the repo market. Trillions of dollars flow through the repo market every day. It's how the financial system manages liquidity on a daily basis. In September of 2019, the repo market seized up. Overnight repo rates spiked from 2% to 10% in a matter of hours. Banks that needed overnight funding suddenly faced catastrophically high interest rates. Why did this happen? Because there wasn't enough liquidity in the system. Banks were holding too much in reserves and not enough in cash that could be lent out. The Fed had to intervene. They had to inject hundreds of billions of dollars to calm the market. That was a warning shot, a preview of what can happen when liquidity gets too tight. But the structural problems haven't been fixed. The repo market is still vulnerable. We're now in a period where the Fed is withdrawing liquidity. Bank reserves are falling. At some point, we could see another repo crisis, except this time it might be worse because the Fed's balance sheet is already large and their credibility on inflation is shaky. If they have to inject massive liquidity to save the repo market while inflation is still above target, it would be a disaster for their credibility. Third, look at what's happening in corporate credit markets. Companies borrow money by issuing bonds. Investment-grade companies issue investment-grade bonds. Riskier companies issue high-yield bonds, also called junk bonds. During the era of zero interest rates, companies issued enormous amounts of debt. Corporate debt in the United States is now over $11 trillion. That's nearly 50% of GDP. Companies borrowed to fund share buybacks, to fund acquisitions, to fund operations, and the debt was cheap. Investment-grade bonds were yielding 2 or 3%. Junk bonds were yielding 5 or 6%. Now that debt is maturing and needs to be refinanced, but rates are much higher. Investment-grade bonds now yield 5 or 6%. Junk bonds yield 8 to 10% or more. Some companies can handle the higher rates. They have strong cash flows, but many can't, especially companies that were already struggling. There are hundreds of billions of dollars in corporate debt maturing over the next 2 years. In 2025 and 2026, we're going to see a massive wave of refinancing, and a significant portion won't be able to refinance at the new higher rates. They'll default. Now here's where the liquidity crisis comes in. When companies default on their bonds, who takes the losses? Bond investors, mutual funds, pension funds, insurance companies, banks. When these institutions take losses, they pull back, they become more cautious, they reduce their lending, they tighten their standards. This reduces liquidity in the credit markets. And reduced liquidity means that the next company trying to refinance faces even worse conditions, higher rates, fewer willing lenders. This creates a negative feedback loop. Defaults cause losses. Losses cause pullback. Pullback causes more defaults. This is how liquidity crises spread. They're contagious. Fourth, look at what's happening in private credit. This is a huge problem that almost nobody is paying attention to. Private credit has exploded over the past decade. These are funds that lend money to companies outside of traditional banks and public bond markets. They grew because investors were desperate for yield in a zero interest rate environment. Private credit funds offered higher returns than public bonds. And the loans were marked at par, meaning they were always valued at full price on account statements, unlike public bonds that fluctuate with market prices. This attracted enormous inflows. The private credit market grew from a few $100 billion to over $1.5 trillion. That's a massive amount of capital. These funds lent to companies that couldn't get loans from banks or couldn't issue public bonds. Often highly leveraged companies. Often companies with weak credit quality. Often companies in struggling industries. And the loans were often floating rate, tied to short-term interest rates. When rates were zero, the borrowers could handle the payments. But now rates are over 5%. Many of these borrowers are struggling. And here's the problem. Private credit funds are illiquid. Investors can't just sell their fund shares like they can sell a stock or a bond. They're locked up for years, and the funds themselves can't easily sell the loans they've made. There's no liquid market for these loans. They're private. So when the borrowers start defaulting, and they are starting to default, the funds take losses. But they can't mark the loans down immediately because there's no market price. They use model-based valuations. They make assumptions about recovery rates. They delay recognizing losses. But eventually, the losses become undeniable. And when investors start asking for their money back, when redemption requests come in, the funds are going to have a huge problem. They can't sell the loans quickly. They'll have to gate redemptions, meaning they refuse to let investors withdraw money. This is going to create panic. Investors in private credit funds are often wealthy individuals, family offices, pension funds, endowments. When they can't get their money out, they're going to pull back from all forms of illiquid investments. This will spread to private equity, to real estate funds, to hedge funds. Liquidity will dry up across all alternative asset classes. And these alternative asset classes are now huge parts of the financial system. Pension funds have significant allocations to private credit and private equity. If those investments blow up, pension funds will face massive shortfalls. They'll have to reduce spending. They might even fail. Fifth, look at what's happening with money market funds. Money market funds are supposed to be safe places to park cash. They invest in very short-term, very safe securities. Treasury bills, commercial paper, repo agreements. After 2008, regulations required money market funds to maintain liquidity and prevent runs. But here's what's happened. When the Fed started raising rates, depositors moved over $1 trillion from bank accounts into money market funds. Why keep money in a checking account earning zero when you can put it in a money market fund earning 5%? This makes sense for depositors, but it's drained liquidity from the banking system. Banks lost deposits. They need deposits to make loans. When deposits leave, banks have to shrink their lending. They have to reduce their balance sheets. This reduces credit availability in the economy. And it makes banks more fragile. Now, money market funds have all this cash, over $6 trillion, and they need to invest it somewhere safe and short-term. Most of it goes into treasury bills and repo. But what happens if there's a shock? What happens if treasury bill yields spike? What happens if the repo market seizes up? Money market funds could face redemption requests. Investors might panic and want their cash. And if money market funds have to sell assets to meet redemptions, that reduces liquidity further. In 2008, one money market fund, the Reserve Primary Fund, broke the buck. Its net asset value fell below $1 per share because it held Lehman Brothers commercial paper that became worthless. This triggered a run on money market funds. Investors pulled hundreds of billions out within days. The entire short-term funding market froze. The Treasury had to guarantee money market funds to stop the panic. We could see something similar in the next crisis, and if we do, it will be a massive liquidity shock. Sixth, look at what's happening with quantitative tightening and the Fed's balance sheet. The Fed's balance sheet is a measure of how much liquidity the Fed has injected into the system. At the peak, it was almost $9 trillion. Now it's around $7 trillion and shrinking. The Fed is letting bonds mature without replacing them. This is quantitative tightening, the opposite of quantitative easing. Every month, the Fed is removing roughly $60 billion in treasuries and $35 billion in mortgage-backed securities from the market. That's over $1 trillion per year in liquidity withdrawal. This is unprecedented. We've never done quantitative tightening at this scale before. The Fed tried a small amount of quantitative tightening in 2017 through 2019. They reduced their balance sheet from $4.5 trillion to $3.8 trillion. And even that modest reduction caused problems. The repo crisis in September 2019 happened partly because the Fed had withdrawn too much liquidity. Now they're doing quantitative tightening on a much larger scale. And they're doing it while the government is issuing record amounts of debt. This is a collision course. The Fed is removing liquidity while the government needs to sell trillions in bonds. Something has to give. Either the Fed stops quantitative tightening and keeps their balance sheet large, which means they're not really fighting inflation seriously, or they continue withdrawing liquidity and we get a crisis. Based on what I'm seeing, I think the crisis comes in 2026. Now, let me walk you through exactly how I think this unfolds, because it's not going to be one single event. It's going to be a cascade of failures across multiple parts of the financial system. Here's the scenario. We're in mid-2026. The Fed has been on pause for over a year. They stopped raising rates in early 2025. But they've continued quantitative tightening. Their balance sheet is down to around $6 trillion, maybe lower. The Treasury is still issuing massive amounts of debt to fund deficits and refinance maturing bonds. Over $7 trillion in issuance per year. Foreign buyers continue pulling back. Banks are still sitting on losses and not buying. The Fed is selling. So who's buying all these treasuries? The answer is that rates have to rise to attract buyers. Treasury yields have been creeping up. 10-year treasuries are now yielding 5%. 30-year treasuries are yielding 5.5%. These higher yields are starting to cause problems. Mortgage rates are back over 7%. Corporate borrowing costs are elevated. The economy is slowing. Then something happens. Maybe it's a geopolitical shock. Maybe it's a major corporate default. Maybe it's a bank failure due to commercial real estate losses. Whatever it is, it spooks the market. Investors rush to safety. They try to buy treasuries. But liquidity in the treasury market is thin. There aren't enough sellers at current prices. Prices spike. Yields fall temporarily. But this creates margin calls for leveraged investors who were short treasuries or long corporate bonds. They have to sell assets to meet margin calls. This selling pressure hits corporate bonds, stocks, everything. Risk assets start falling. Now other investors panic. They try to sell too, but buyers disappear. Market liquidity evaporates. Corporate bond spreads blow out. Junk bond yields go from 8% to 12% to 15%. Companies that need to refinance debt can't. The cost is prohibitive. They start defaulting. The defaults spread. Highly leveraged companies go first. Then companies with weak business models. Then companies in industries under stress, like commercial real estate, retail, some industrials. Each default creates losses for lenders. Banks, credit funds, bond mutual funds. These institutions pull back. They stop lending. They tighten standards dramatically. Credit markets freeze. Companies can't get funding. The economy seizes up. Meanwhile, the stress spreads to private credit. Redemption requests flood in. Investors want out. They see defaults accelerating. They see valuations that were marked at par now being marked down. They realize they've been holding garbage. The private credit funds can't meet all the redemptions. They don't have the cash. The loans can't be sold quickly. They gate redemptions. They tell investors they can't have their money back. This causes panic. If you can't get money out of private credit funds, where else are you locked in? Investors rush to sell anything they can sell. Stocks, liquid bonds, anything. They need to raise cash because they can't access their private credit investments. This selling pressure hammers liquid markets. Stock prices fall 20%, then 30%. The volatility attracts algorithmic traders and high-frequency traders who start pulling back. They reduce their activity. This reduces market liquidity even further. Now you have a full-blown liquidity crisis. Asset prices are falling. Credit is frozen. Nobody can get funding. Companies start announcing emergency measures, cutting costs, laying off workers, canceling investments. The economic impact accelerates. Unemployment starts rising quickly. Consumer spending falls. This hits corporate profits. More companies get into trouble. More defaults. The cycle feeds on itself. Now let's talk about the banking system. Banks are already under stress from unrealized losses on their bond portfolios and from commercial real estate exposure. When the liquidity crisis hits, it gets worse. Banks need funding every day. They borrow in short-term markets to fund their operations. But in a liquidity crisis, funding costs spike. Other banks become unwilling to lend. They don't know who has exposure to failing companies or to private credit funds or to other areas of stress. Counterparty risk explodes. Banks pull back from lending to each other. Interbank lending markets freeze. This is what happened in 2008. Banks that need funding can't get it. They're forced to sell assets. They have to liquidate their treasury holdings, their corporate bonds, their loans. This selling pressure hits markets even harder. Prices fall further. And the banks take losses on the sales. These losses eat into their capital. Some banks become critically undercapitalized. Regulators step in. They seize banks. They try to arrange mergers. But who wants to buy a failing bank in the middle of a crisis? We see a wave of bank failures. Not just small banks, but medium-sized regional banks. Maybe even a large bank. The FDIC is now dealing with multiple failures. The Deposit Insurance Fund gets depleted. The FDIC has to borrow from the Treasury. Now the government is bailing out banks again. The political backlash is enormous. People are furious. We did this in 2008. We said never again. And here we are doing it again. Meanwhile, the Federal Reserve faces an impossible choice. The economy is cratering. Markets are crashing. The financial system is seizing up. Every instinct says they should cut interest rates to zero and restart quantitative easing. Inject massive liquidity to stop the panic. But here's the problem. Inflation is still elevated. Remember, they paused rate hikes in early 2025 when inflation was still at 3%. They never got it back to 2%. And now, with a financial crisis, with potential bank failures, with the government spending massively on bailouts, inflation expectations could become unanchored. If the Fed cuts rates to zero and prints money to buy assets, they risk reigniting inflation. They risk destroying their credibility completely. They risk creating a situation where inflation becomes endemic, where it stays at 5 or 6% or higher permanently. But if they don't act, if they let the financial system collapse to preserve their inflation-fighting credibility, we get a depression. Unemployment goes to 10% or higher. GDP falls dramatically. It's 2008 all over again, but potentially worse. This is the impossible choice, and it's a direct result of the Fed's mistakes over the past 15 years. They created too much liquidity for too long. They enabled excessive leverage and risk-taking. They inflated bubbles. And now when they try to normalize, when they try to withdraw the liquidity and raise rates, the system can't handle it. It's addicted to easy money. The withdrawal causes collapse. This is the liquidity crisis I see coming in 2026. It's not certain, it's not guaranteed, but the probability is high enough that you need to prepare. Now, let me tell you about some warning signs to watch for. These will tell you if we're heading toward this scenario. First, watch Treasury market liquidity metrics. The Treasury Department and the Fed publish data on bid-ask spreads, market depth, and trading volumes in the Treasury market. If you see bid-ask spreads widening significantly, that's a warning sign. If you see market depth declining, meaning fewer buyers and sellers at each price level, that's a warning sign. If you see days where trading volumes are extremely thin, that's a warning sign. You can find this data on the New York Fed's website and on Treasury's website. It's publicly available. Most people don't look at it, but it's one of the best indicators of systemic liquidity stress. Second, watch the repo market. Overnight repo rates should trade close to the Fed's target rate, which is currently around 5 to 5.25%. If you see repo rates spiking above that, if you see sudden jumps to 6 or 7 or 8%, that's a warning sign. It means there's not enough liquidity in the overnight funding market. The Fed publishes repo rates. You can track them daily, pay attention. Third, watch corporate bond spreads. Investment-grade corporate bonds should trade at a spread of 100 to 200 basis points, 1 to 2 percentage points above treasuries. Junk bonds should trade at a spread of 400 to 600 basis points, 4 to 6 percentage points above treasuries. If you see those spreads widening significantly, if investment-grade spreads go to 300 or 400 basis points, if junk spreads go to 800 or 1,000 basis points, that's a warning sign. It means credit markets are under stress. Investors are demanding much higher compensation for risk. The bond market is pricing in significantly higher default rates. You can track this through the Bloomberg Barclays investment grade and high-yield bond indexes, or you can watch high-yield bond ETFs like HYG or JNK. If their yields are spiking, spreads are widening. Fourth, watch money market fund flows. If you see large outflows from money market funds, if investors are pulling cash out rapidly, that could be a sign of panic. It could mean they're worried about safety. Or conversely, if you see huge inflows into money market funds, it could mean investors are fleeing from risk assets and rushing to cash. Either direction, large sudden moves in money market fund balances are a warning sign. The Investment Company Institute publishes weekly data on money market fund assets. Track it. Fifth, watch the Fed's balance sheet. The Fed publishes their balance sheet every week. If they suddenly stop quantitative tightening, if they start growing their balance sheet again, even though inflation is above target, that's a sign they're worried about liquidity. It means they see stress in the system and they're intervening. That's a warning sign that things are worse than they're publicly admitting. Sixth, watch bank stock prices. Banks are levered plays on the financial system. When systemic liquidity gets tight, banks feel it first. If you see bank stock prices falling sharply, especially regional banks, that's a warning sign. Watch the KBW Bank Index or the SPDR S&P Bank ETF, ticker KBE. If it's falling while the broader market is stable or rising, that's concerning. It means banks are under pressure. Seventh, watch for credit events. When major companies default on their debt, when banks fail, when private equity deals blow up, these are signals. Each one individually might not mean much. But if you start seeing multiple credit events in a short period, that's a pattern. That's a sign that leverage in the system is too high and it's starting to break. Now let me tell you how to position yourself to survive and potentially profit from this crisis. Because if you prepare correctly, a liquidity crisis creates enormous opportunities. First, liquidity is going to be king. Cash and cash equivalents will be the most valuable assets to hold. When everyone needs liquidity, and nobody has it, the people with cash can buy assets at fire sale prices. I'm holding a significant amount in cash and treasury bills. Probably 30% of my liquid portfolio. Yes, I'm losing to inflation. Yes, I could be earning higher returns elsewhere. But when the crisis hits, when asset prices crash, I'll be able to deploy that cash at much better valuations than anything available today. Treasury bills are particularly attractive. They're yielding over 5% right now. They're completely safe. They're highly liquid. You can sell them instantly. And in a crisis, when flight to safety happens, Treasury bills might be the only asset that holds value or even appreciates. Second, avoid illiquid investments completely. Do not put money in private credit funds. Do not put money in private equity funds unless you're absolutely certain you won't need that capital for a decade. Do not buy illiquid real estate. In a liquidity crisis, illiquid assets are death. You can't sell them. You can't access your capital. You're trapped. Even if the underlying assets are good quality, if you can't sell them when you need to, they're worthless to you. Liquidity is more valuable than returns in a crisis. Third, if you own stocks, focus ruthlessly on balance sheet strength. Companies with net cash, zero debt, or minimal debt, these will survive. Companies with high debt loads, even if they're profitable now, they're at risk. Look at the debt maturity schedule. If a company has billions in debt maturing in 2026 or 2027, they're vulnerable. They might not be able to refinance. I'm looking at companies like Berkshire Hathaway, which has over $150 billion in cash and short-term investments. Or companies like Microsoft, Google, Apple that generate enormous free cash flow and have minimal debt. These companies will not only survive a liquidity crisis, they'll come out stronger because they can acquire distressed assets and competitors. Fourth, be very careful with corporate bonds. Even investment-grade bonds are at risk if we have a wave of downgrades. In a severe crisis, companies that are investment-grade today might be junk-rated tomorrow, and bond prices follow ratings. If I were holding corporate bonds, I'd focus on very short duration, 1 to 3 years, and only the highest quality issuers. Or I'd avoid them altogether and stick to treasuries. Junk bonds are a disaster waiting to happen. Default rates are going to spike. If you own junk bonds or junk bond funds, get out. Fifth, consider shorting or buying put options on vulnerable sectors. Commercial real estate investment trusts are obvious targets. They're highly leveraged. They own properties that are declining in value. They need to refinance debt. Many will fail in a liquidity crisis. Highly leveraged retailers, airlines, companies dependent on easy credit access, these are also vulnerable. But be careful with shorting. Timing is difficult. You can be right about the direction, but wrong about the timing and lose money paying borrow costs or option premiums. Only do this if you really understand the mechanics. Sixth, gold might perform well in a liquidity crisis. In the initial phase, when everyone is selling everything to raise cash, gold might fall. But if the Fed is forced to inject massive liquidity to save the system, if they restart quantitative easing while inflation is elevated, gold could soar. It's a hedge against currency debasement and loss of confidence in central banks. I'm holding some gold, not a huge amount, but 5 to 10% of my portfolio. Seventh, be positioned to act quickly. Have accounts set up at brokerages. Have cash ready to deploy. Have a list of companies or assets you'd want to buy at much lower prices. When the crisis hits, opportunities will appear, but they won't last long. The best prices might only be available for days or weeks. If you have to spend time opening accounts and moving money, you'll miss it. Be ready. I have specific stocks I'm watching. Companies with fortress balance sheets that I'd love to own at 30 or 40% discounts to current prices. Companies that will not only survive the crisis but thrive afterward. When prices collapse, I'll buy aggressively. Eighth, understand that this will be painful and scary. Watching your portfolio drop 30 or 40% is psychologically difficult even if you've prepared for it. Watching banks fail is scary. Watching the media talk about financial collapse is terrifying. You have to have the emotional fortitude to stay calm, to not panic sell, to actually buy when everyone else is selling. This is what separates successful investors from unsuccessful ones. Everyone wants to buy low and sell high. But when low comes, when markets are crashing and the news is terrifying, most people can't do it. They panic, they sell, they lock in losses. The investors who build generational wealth are the ones who can stay calm during crises, who can see past the panic to the opportunity, who can deploy capital when assets are truly cheap. I did this in 2008. When everyone was panicking, when people thought the world was ending, I stayed calm. I knew housing would eventually stabilize. I knew the government wouldn't let the entire system collapse. I knew asset prices had overshot on the downside just like they'd overshot on the upside, and I positioned accordingly. I made enormous returns not from the short side, though that's what I'm famous for, but from buying assets that had been thrown away at absurd prices in late 2008 and early 2009. I'm preparing to do the same thing in the next crisis. Let me also talk about some scenarios where I might be wrong, because I'm not claiming certainty here. I'm assessing probabilities. Maybe the Fed perfectly manages the liquidity withdrawal. Maybe they find the right pace of quantitative tightening that removes excess liquidity without causing a crisis. Maybe they pause quantitative tightening at just the right moment. Maybe corporate debt refinancing goes smoothly because companies have stronger cash flows than I think. Maybe private credit defaults are contained and don't spread. Maybe foreign buyers come back to the treasury market and provide the demand needed. Maybe the government suddenly gets fiscal discipline and stops running massive deficits, reducing the supply of treasuries. These are possible, but based on history, based on the scale of the imbalances, based on the interconnectedness of the financial system, I think the probability of a smooth outcome is low. More likely, something breaks. And when it does, it will spread quickly because modern markets are so interconnected and move so fast. Even if the crisis doesn't unfold exactly as I've described, even if the timing is different or the trigger is different, the underlying risk is real. The financial system is over-leveraged, it's dependent on abundant liquidity, and that liquidity is being withdrawn. Those are facts. How and when the system breaks is uncertain, but that it will experience severe stress seems highly probable to me. Let me tell you one more thing. The people who will be hurt worst in the next crisis are the ones who've been taking the most risk. The ones who've been reaching for yield in junk bonds and private credit. The ones who've been buying stocks on margin. The ones who've been leveraging up in illiquid investments. These people will be wiped out. In 2008, it was the people who had adjustable rate mortgages and home equity lines of credit who lost their homes. It was the people who'd borrowed to invest in real estate. It was the people who'd believed housing prices could only go up. The prudent people, the ones who had fixed rate mortgages or no mortgage, the ones who had savings, they were fine. They bought houses at 50 cents on the dollar when prices crashed. They built wealth. This time will be the same. The people who've been prudent, who've maintained liquidity, who've avoided excessive leverage, who have strong balance sheets, whether personally or in their investments, they'll be fine. The people who've been reckless will be destroyed. So ask yourself which side you want to be on. Do you want to be the person who gets wiped out? Or do you want to be the person who survives and thrives? Do you want to be forced to sell at the bottom? Or do you want to be buying at the bottom? The choice is yours, but you have to make it now. Once the crisis hits, it's too late. I'm telling you this because I see it coming. I see the same patterns I saw before 2008. The same excessive leverage, the same dangerous assumptions, the same belief that this time is different, that the rules don't apply. But the rules always apply. Leverage always eventually causes problems. Illiquidity always eventually causes crises. These are laws of finance. They don't change. The specific details of each crisis are different. The assets that blow up are different. The institutions that fail are different. But the underlying dynamics are always the same. Too much debt. Too much leverage. Too much assumption that liquidity will always be available. And then one day, it's not. One day, everyone needs cash at the same time. One day, the buyers disappear. And the whole thing collapses. We're heading toward that day. I think it comes in 2026. Maybe late 2025. Maybe early 2027. The exact timing is uncertain. But the direction is clear. Liquidity is being withdrawn from the system. Credit conditions are tightening. Leverage is still elevated. Corporate debt maturities are piling up. Private credit is full of losses that haven't been recognized. The treasury market is under stress. These are all facts. They're not opinions, they're observable in the data. And when you put all these facts together, when you understand how they interact and reinforce each other, the conclusion is clear. We're heading for a liquidity crisis. And you need to prepare. So here's what I want you to take away from this. Understand that liquidity is the lifeblood of the financial system. When it dries up, everything breaks. Recognize that the Fed has been withdrawing liquidity through rate hikes and quantitative tightening. This creates stress that takes time to manifest. Watch the warning signs I described. Treasury market liquidity, repo rates, credit spreads, money market flows, bank stocks. Position yourself defensively. Hold cash. Avoid illiquid investments. Focus on balance sheet strength. Be ready to act when the crisis hits. Be ready to buy when everyone else is panicking. And understand that this isn't about fear-mongering. This is about reality, about understanding how the financial system works, about recognizing when risks are elevated, about being prepared. I've been studying financial markets for decades. I've lived through multiple crises. I've made my career by seeing things others missed. And right now, I'm seeing a liquidity crisis building. I'm seeing the same dangerous dynamics that preceded past crises. I'm seeing a system that's fragile and dependent on liquidity that's being withdrawn. I don't know if it will unfold exactly as I've described, but I know the risk is real. And I know that the people who prepare will survive and potentially thrive. The people who don't will suffer. Make your choice. Position yourself accordingly. And whatever you do, don't say nobody warned you.